Hey guys, I'm Greg Hardy, and welcome to my channel. Today we're tackling a topic that's on the minds of millions of people, student loans. Whether you're just starting to pay them off or you're deep into your repayment process, this video is for you. So stick around because I'm going to share with you some powerful strategies to manage and pay off your student loans faster than you ever thought possible. Student loans account for a staggering $1.6 trillion in total debt. The average balance for student loan borrowers is $38,787 with an average monthly payment of $300. As of the fourth quarter of 2023, borrowers aged 25 to 34 held $491 billion in federal student loan debt, while those aged 35 to 49 carried even more, totaling $624 billion. People aged 50 to 61 owe about $278 billion, and those 62 and over hold $110 billion. So regardless of your age, student loan debt is a significant issue. The U.S. Department of Education reports that 43.2 million borrowers had outstanding federal student loans as of the fourth quarter of 2023. While education is often seen as a future investment, the burden of student loan debt can be overwhelming. Many graduates start their career with substantial loan balances, limiting their ability to save, invest, or achieve their financial goals. High monthly payments and interest can hinder wealth accumulation and delay major life milestones such as buying a home or even saving for retirement. So let's go over 7 steps that you can use to manage and pay off your student loans. But before we do that, I ask that you hit that like button and also consider subscribing to this channel if you'd like to grow your wealth. It will also allow this video to reach a wider audience and help even more people. So let's get started. First, you need to understand what type of loans you have. Are they federal or private loans? What are the interest rates and terms? Understanding the types of loans you have is a critical step in managing your student debt effectively. Federal loans are typically issued by the government and come with benefits like fixed interest rates, income-driven repayment plans, and potential forgiveness programs. Private loans, on the other hand, are provided by banks or other private lenders and usually have variable interest rates and fewer repayment options. Knowing whether your loans are federal or private will help you to identify what repayment benefits and protections you might be eligible for. To get a clearer picture of your loans, you should log into your loan servicer's website and review your loan documents. Your loan servicer is the company that manages your loans and handles the billing and other services. By checking online or through your documents, you can find out the interest rates, repayment terms, and any other specific conditions attached to your loans. This information is essential because it allows you to create a repayment strategy that works best for you and for your financial situation. Taking the time to gather these details may seem tedious, but it will help you manage your loans more effectively and could save you money in the long run. So log into your loan servicer's website or check your loan documents to get this information. Trust me, it's worth the effort. Creating a budget is an essential next step in managing your student loan payments. Start by listing all of your income sources, such as your salary, any part-time work, or other regular income. Then write down all your monthly expenses, including rent, utilities, groceries, transportation, and any other bills you might have. This process helps you see exactly how much money you have coming in and going out each month, giving you a clearer picture of your financial situation. Once you have a detailed list of your income and expenses, prioritize your student loan payments. Make sure you allocate enough money to cover at least the minimum payment due on each loan every month. Paying the minimum on time is crucial to avoid late fees and negative impacts on your credit score. If possible, try to allocate extra money towards your loans to pay them off faster and reduce the total interest you will pay over time. By organizing your budget and prioritizing your loan payments, you can manage your debt more effectively and work towards financial stability. When it comes to federal student loans, you have several repayment options to choose from, each designed to fit different financial situations. The standard repayment plan is the default option, where you pay a fixed amount each month for up to 10 years. This plan is pretty straightforward and usually results in paying less interest over time, but the monthly payments can be relatively high. On the other hand, income-driven repayments, or IDR plans, adjust your monthly payments based on your income and family size, making them more affordable if you have a lower income. These plans include options like income-based repayment, which is also known as IBR, and pay-as-you-earn, which is PAYE, which can extend the repayment period up to 20 to 25 years, potentially leading to loan forgiveness after that period. Each repayment plan has its own advantages and disadvantages. The standard repayment plan helps you pay off your loans faster and saves on interest, but it might not be feasible if your monthly payments are too high compared to your income. IDR plans offer a more manageable payment, but you might end up paying more in interest over the life of the loan due to the extended repayment period. To figure out which plan is best for your situation, use the repayment estimator tool available on the Federal Student Aid website. This tool allows you to input your loan details and financial information to compare different repayment plans side by side. It provides a clear picture of what your monthly payments would be under each plan and how much you would pay in total, helping you to make a more informed decision about managing your loans effectively. One of the most effective strategies to pay off your student loans faster is to make payments above the minimum required amount each month. By paying an extra $50 or $100, you can significantly reduce the overall balance of your loan more quickly than if you only made the minimum payments. This approach helps because the extra money goes directly towards reducing the principal, which is the original amount you borrowed. As the principal amount decreases, the amount of interest you owe also decreases, leading to even more savings over time. To ensure that your extra payments make the biggest impact, you need to specify to your loan servicer that the additional amount should be applied to the principal and not the interest. Most loan servicers will apply any extra payment to the interest first unless you tell them otherwise. By directing the extra money towards the principal, you lower the amount on which future interest is calculated. So, over the life of the loan, this can lead to substantial savings and help you become debt-free sooner. Making these extra payments can be a manageable way to tackle your debt more aggressively. Even small, consistent additional payments can accumulate and lead to a quicker payoff. This method not only reduces the total amount of interest paid, but also gives you that psychological benefit of seeing your loan balance decrease faster. Setting up automatic payments or reminders can help you stay on track with your goal of paying off your student loans ahead of schedule. Now, if you have private loans or federal loans with higher interest rates, refinancing might be a beneficial option to consider. Refinancing involves taking out a new loan with a lower interest rate to pay off your existing loans. This can lower your monthly payment and potentially save you a significant amount of money in interest over time. By securing a lower rate, more of your payment goes towards the principal rather than the interest, helping you pay off the loan faster and more efficiently. However, it's important to be aware of the trade-offs, especially if you're refinancing federal loans. When you refinance federal loans with a private lender, you lose access to federal protections and benefits. These federal benefits include income-driven repayment plans, loan forgiveness programs, and deferment or forbearance options that could be crucial if you face financial difficulties in the future. Therefore, it's essential to weigh the potential savings against the loss of these protections before deciding to refinance. To get the best refinancing deal, it's a good idea to shop around and compare offers from different lenders. Look at the interest rates, the repayment terms, and any associated fees with refinancing. Different lenders may offer various rates and terms, so comparing these details can help you find the most favorable option for you and for your situation. Taking the time to research and compare offers ensures you get the best possible rate and terms, maximizing the benefits of refinancing your student loans. If you receive a tax refund, bonus, or any unexpected money, a smart move is to put it towards your student loans. These extra funds can make a huge impact on reducing your overall loan balance. By using Windfalls to make larger payments, you can lower the principal amount of your loan more quickly than just making those regular monthly payments. This not only brings down the total amount you owe, but will also reduce the interest that accrues over time, saving you even more money in the long run. Using unexpected money for loan payments can significantly accelerate your repayment progress. For example, say you apply a $1,000 tax refund directly to your loan principal amount. You can shorten your repayment period and decrease the overall interest you'll pay. This approach will help you to take advantage of money you weren't counting on, turning it into a powerful tool to reduce your debt burden more effectively. In addition to saving on interest, making extra payments whenever you get unexpected money also provides that psychological boost. Watching your loan balance drop more quickly can be motivating and encouraging, reinforcing your commitment to paying off your debt. It transforms what could have been spent impulsively into a strategic step toward financial freedom, helping you become debt-free sooner than you had planned. Celebrating small victories along the way can also boost your morale and keep you engaged in your repayment journey. For example, when you reach a milestone, treat yourself to a special meal, a small gift, or an activity that you enjoy. These celebrations don't have to be extravagant, but should be meaningful enough to acknowledge your hard work and dedication. Recognizing and rewarding your progress helps maintain a positive attitude and reinforces your commitment to the ultimate goal. Guys, always keep your end goal in mind: financial freedom. Visualizing what life would be like without student loan debt can be a powerful motivator. Think about the financial flexibility and peace of mind you'll gain once your loans are paid off, whether it's saving for a house, traveling, or simply just having more disposable income. These future benefits can drive you to stay the course. By breaking the repayment process into manageable steps and celebrating your achievements, you can maintain the motivation needed to complete your marathon journey to financial freedom. So there you have it, 7 steps to manage and pay off your student loans. Now remember, understanding your loans and having a solid plan can make all the difference. With these strategies, you'll be on your way to a debt-free future. Feel free to share in the comments how your journey to paying off your student loans is going. How much have you paid off? How much you have left? And when your goal is to have them all paid off. Also, thank you for taking time out of your day to watch this video. Now, if you want to learn more about growing your wealth, then check out this video right here. But before you do that, don't forget to like and subscribe. Thank you all so much for watching. I really hope you liked this video and that you got something out of it. I'll see you in the next one.